Congratulations for taking ownership of your financial plan by tuning into the Federal Employee Financial Planning Podcast, hosted by Mason & Associates, financial advisors with over 3 decades of experience serving you. You will rest easy once your plan is done. You will see clearly just how you have won. Gone are the times where you'd hope and pray. It's gonna be a bright, sunshiny day.
Welcome to the Federal Employee Financial Planning Podcast. I'm John Mason, President and Certified Financial Planner. And on today's episode, the usual crew, Tommy Blackburn, Ben Rakes, and Michael Mason. Folks, this podcast, you've been listening now for almost 2 years, but I think it's good to reiterate that this may be one of the most credentialed podcasts out there, not only on the financial planning front, but certainly when you combine our education, CFPs, CPA, enrolled agent, CLU, CHFC with our knowledge on federal employee benefits. It is probably second to none. So thank you. Big shout out. Thank you to being on this journey with us. We're excited to be wrapping up 2023. We're recording this in November, or it's October 30th today. So the World Series is going on. We're going to have a fun episode as we talk about baseball financial planning and what that means at Mason & Associates and what that means for you as a federal employee. So as we get this kicked off, thank you for being here. Do all the things for us. Like, subscribe, hit the bell notifications. And oh, by the way, our YouTube channel has rebranded to youtube.com/@Fed Employee Financial Planning. So you'll be able to see other content there. And we hope to be producing this video podcast soon on that channel as well. You know, the only negative, guys, that I can think of with this YouTube video podcast is I didn't change shirts after we recorded the last one. So now people are going to know that we record multiple of these in a single day.
Well, I guess we live and we learn, and that's an improvement we'll make going forward. But the cat's out of the bag, right? The secret's out. We've told you before our process is to surge, or maybe we haven't necessarily called it surge, but we do all of our strategic planning meetings in bunching. So it's just kind of a trick that we do for many things around here is we try to batch tasks together to become more efficient and better at it.
So what you're telling me is I need to have more than 2 shirts?
We need to get you a couple shirts, Mike. And maybe next time I'll wear a dress shirt next time. Maybe we can all match or something. We also have a new brick wall behind us, which is pretty exciting. So things at Mason & Associates.
We tore it down to the brick, right? We took the drywall out and there's brick back there.
Well, we had to get bricks for the Mason & Associates, right? So it's fall tax planning season right now. So this is really exciting for us too. So I think for our audience to just maybe understand what it means to be a client of Mason & Associates before we go into baseball financial planning is we have 4 dedicated touch points that happen throughout the year. And it's a little bit different for everybody. But number 1 is the first quarter. And that's when we do help clients prepare and file their tax return. So we don't do the data entry, but we certainly will review the return before it's filed. We also help provide source data to CPAs or send it to clients as needed. And also what we're doing during this time is preparing for our strategic planning meeting. And the strategic planning meeting is that once a year strategy session where we're looking forward to say, what can we do this year to improve our financial plan? Because remember, things here are what they seem: support, empower, educate, and motivate not only people on the YouTube channel and our podcast, but actually real clients to make changes in their financial plan. That's what we do in the second quarter. Third quarter, we implement, and fourth quarter, we wrap it up with some end-of-year tax planning. So if whoever wants to share what end-of-year tax planning looks like for our listeners, I think they'd be glad to hear that.
You know, a simple one for me. A client was looking for a new tax preparer. We sent over last year's tax return, and the preparer says, maybe I want to do a mock tax return for this year to make sure they're ahead of the ball game. And I pulled up the one we had already done, and of course, with the client's permission, sent it over to the CPA. But I also had 2024's projection, and I let the CPA know that there's a task in November to call the client and say, look, once you're retired for the full year, you're not having enough taxes taken out at the federal level. So we're going to increase that to $400 in December, to take effect in January.
I love that, Mike, because you really hit it on the head there. I'm encountering that a lot right now. I think we all are as we're doing our end of year tax projections. So this is where we're taking income and withholding year to date, anything specific about your situation, and circling back to say, hey, looks like we're going to owe, looks like we're going to get a refund. Here's where we are right now and whether I think we should take some moves or not. One of the most common this time of year is a Roth conversion. Could also be realizing some capital gains or losses. But to your point, that's always that extra step that I think we all do take. But there are times where I'm like, all right, I'm done. I was like, wait a minute, I got to go look at 2024 because something changed and say, okay, so here was 2023 snapshot. I'm going to get back in touch with you in January because something else has changed and we need to make a withholding adjustment. That's definitely going that extra mile. And I think that's a great example.
It's so important. I mean, really, not all of our clients have tax planning action items that have to happen at the end of the year, but there's a lot of peace of mind knowing in November or December, or even if it was in January, what April 15th is going to look like. There's just so much peace of mind knowing, yes, I'm ahead of the game, or no, I'm behind. And right now you have the opportunity to make adjustments. So remember, tax planning ends on December 31st.
So what are you saying to the audience, John? That we give tax advice?
We do. That's very exciting. That's very exciting. Most people are very scared of tax advice. We love it at Mason and Associates. So avoiding surprises and tax planning and being proactive and not waiting until April 15th to figure out what the answer is very important, because now we have interest rates again. And now all of a sudden, if you're underpaid, not only do you have underpayment penalties, you have interest on top of that. So things start to stack up pretty quickly, don't they?
And because of that interest, right, that $50,000 bank account that was earning zero before is now actually going to throw some interest income on your return. And to your point, let's not have a surprise in April and tell you, hey, you had $2,500 more of income this year. We probably need to account for that. I think other end of year planning is QCDs, charitable giving, as Tommy said, seeing if we have any capital gains or maybe even capital losses. Again, peace of mind knowing April 15th is coming and you don't have to cross your fingers and just hope that you got it right this year.
The other fun little piece of advice here, or planning technique we use, I know I've encountered this here recently with these end of year tax projections, is saying, okay, looks like we're going to owe. One, there's a decision point to be made of, do we pay it now? Do we fix this now? Or do we just wait until we file? And, there are arguments and things to weigh there. Part of it is, how do we fix it? Beyond just getting withholding right for 2024. If we know we have a shortfall this year, what are we going to do? If anything, are we going to make an estimated tax payment? But I had a fun conversation with a client. Fun. This is my version of fun, right? We're talking about taxes. And the point was, we can change your withholding. Because they said, should we do an estimated tax payment? I said, you could do it that way, but the best way would be if we change your withholding and get it in the system that way. And of course, there was a discussion around why do you say that? And the reason is withholding is treated as if it is paid evenly throughout the year. Whereas the point here with the client was, if we pay it in Q4, Uncle Sam, the state of Virginia, they're not unaware of what you just did, that you were underpaid throughout the entire year and you made it correct at the end of the year. So they will still penalize you. We do it under withholding. We avoid it. So it's more legwork, but that's the cleanest way to do it. And I guess another simple way to put it that I've explained to clients is, when you get paid, the government expects to get paid. So they want you to make your payments timely.
Well, I love the two things real quick. One, Ben called out the interest, which I think is so important. We had to call out the interest. And then for our clients, a lot of people own government money market funds as well. And those are very high government obligations, meaning they're not taxed in Virginia. In many states, probably most states, Tommy Ben could elaborate, but the majority of states probably don't tax the government obligation interest either. So remember, when you're filing your tax return this year, if that's you, the interest on your no penalty CD maybe is taxable, both federal and state, but those government obligations maybe not. And then Tommy, to your point on adjusting the withholding and the government needing to get paid at the appropriate time, also relevant. Even if you were doing the estimated payment, how many times have we seen that the tax preparer doesn't report the estimated payment correctly or doesn't report the income correctly, right? So if we do a conversion, Mike, in Q4, we have to basically tell TurboTax or the tax preparer, I didn't do that $100,000 conversion evenly throughout the year. It occurred in November. So the reason my estimated payment happened in November is because that is when the income came in.
Bingo. Tommy, you'll also like this, and then I think we'll get not to bingo, but to baseball, right? That same client was going to come up, I don't know, $800-900 short on their state return. And I didn't even remember I did this 6 months ago when I did the strategic planning meeting. But I made the note. I said, you can just pay that at the end of the year because next year, 10,000 more of your retirement from the military is not going to be taxed, and that'll fix it. So you don't have to get in and have more taken out this year and then have to do it again, take it off next year. So I thought that was...
I think it's great. We're always looking around the corner, I feel like is my message there. And it's also a little bit of a segue or a tangent why we only serve but so many clients. I mean, because you can't look around the corner for thousands of clients like that. You have to have a deep relationship to take that level of care.
So let's transition into baseball. So baseball financial planning. So this is really applicable in two ways, I think, is, financial planning baseball for the federal employee, for the people listening to this. Like, what are the things that they can be doing to make sure that they win the game? Like, what are the things they can be doing? But then also, like, if you're working with a financial planner, is that financial planner playing ball too? Like, do they care about the singles, the doubles, the base hits, the sacrifice bunts, or are they only looking for grand slams? Like, I feel like there would be a very big disconnect if there's a federal employee or financial planning client who wants to do all these small things right, but then like the manager of the game or the financial planner is ignoring all of that, just waiting for the grand slam.
Yeah, and then let's talk about a good example of that. So you meet a financial planner, they impress you enough that you say, okay, what do you want me to do? And the financial planner says, well, that $800,000 in your TSP, it'll pay us. So let's roll that over. We'll do as good a job as TSP. So they want the $800,000 grand slam, I guess, or home run. But do they want to work hard enough to open 2 more applications to get you to fund Roth IRAs at $7,000 or $7,500? So that's the difference between both people being in the game or just one of them being in the game.
Sure, and even things, it's amazing. Like we prepped for this podcast, right? We prepped, but things continue to come to my mind. So beneficiary designations, that is... that's a single or a double for clients.
Yep.
But then for advisors to go back and say, okay, do we need to update those beneficiary forms? And then we create the paperwork to do that. Like, that's a sacrifice bunt. Like, that's good financial planning, but it's also a sacrifice bunt as the advisor team to make sure that we're churning out paperwork to make sure that these things are staying up to date. And we just know that there's not a lot of companies out there. There's not a lot of financial planning firms out there that will do the sacrifice bunt. Like, they're very interested in the TSP, but they're not super interested in generating forms that don't result in compensation.
Yeah, it's almost even batting practice for the advisor to do that, because there's not much gain at that moment for the advisor. Now, there's a whole lot of gain when somebody dies because you got everything tied up so nice and neat, but it's almost like batting practice.
That's what I was just wondering too, because I had wrote down these same things for estate documents, the planning and getting the beneficiary designations, and it does feel like batting practice on the front end, but it is a home run when someone dies having these things in place. I don't know how you categorize it.
Well, it's pretty short-sighted, to not make sure that you have your benefit. Like, if you haven't dotted your I's and crossed your T's, you're going to wake up and you're going to lose the game at some point. Like, I don't care if you're Bryce Harper or Barry Bonds or Mark McGwire or Chipper Jones, you name them. If you don't do batting practice for 25 years, eventually you're not going to be a very good major league hitter.
It's a different game, but are we talking about practice?
We're talking about practice?
Many games have been won on sacrifice bunts. I guess what we just came across is you don't know which run in the game necessarily won it. What piece of advice we're doing, because again, if it was survivor benefits or the survivor benefit open season and you got somebody's foot in the door, that was work. It was just work on our part, but it was a game winner when it needed to be, right? So you don't even know what you're doing that might be the difference between winning that game and losing it.
I think we'll do another episode, podcast episode with these topics a little bit further. But to me, it's examples of stacking the deck, of making the game unfair to your advantage. It's these little things, and it's also building the brick house, right? These are the bricks that make it so your house doesn't get blown down. Which one of these won the game? It all comes back together.
It's so, this is taking such a turn, right? This podcast is taking such a turn, but it's like you're going to make a call to take survivor benefits. You're going to make a call to do a Roth convert. You're going to make all of these strategic decision-making calls. And in the moment, right now, it feels like that's silly, or that's like not moving the needle, or really survivor benefits, I don't need that. And it feels like everything is a single, or it feels like everything's a sacrifice bunt. But one day you're going to wake up 25 years from now and you're going to realize what each of those decisions actually were. Like, we can say taking survivor benefits is a sacrifice bunt today because you're leaving your income, you're giving it up. You're literally sacrificing income in exchange for SBP. But if you die tomorrow, what do you think your surviving spouse is going to say? Grand slam, baby. Like, I'm sorry you're dead, but I'm okay, right? Like, that was a grand slam decision that felt like an everyday sacrifice bunt or like minuscule decision.
So again, this is fun. So there's the Abbott and Costello, who's on first, what's on second. So it's maybe we should talk about the players that are on the field. So you put SBP on first. So SBP's in the game, right? TSP's in the game, Roth IRA's in the game, buying your military time's in the game. And at any given point, one of those players can win the game for you. Mm-hmm. You just don't know which ones. Together, they're always going to win. And the more you have on the field, but at any given point, that SBP.
You don't know who your superstar is yet. You don't know who won the game. You don't know who came up with the clutch hit.
We just know we need them.
We just know we need all the players, and having a team around you, like extending that metaphor further, is your financial planning team, your tax planning team, your estate planning team, like your trusted professionals, of course. So this has been a really interesting way to open up this topic. What are some financial planning decisions, if you will, that we would consider base hits for federal employees? Like, what are the things that, are good things that we just want to keep hitting those singles over and over and over again?
I'll kick it off. We've said it once or twice, but how many clients have we met, prospects that become clients, that nobody wanted to take the time to open Roth IRAs? So you open the Roth IRAs, you can fund them. If you can't, you can backdoor fund them, and it doesn't look like much when you start at $7,500 per person, but it's a base hit, and it begins the process.
I think making sure that you are contributing at least 5% to your TSP, not leaving that free money on the table. That might not even be a base hit. That just might be making sure the right cleat is on the right foot at that point.
And I was going to stop for a second, and we're speaking to our federal employees and retirees, but what we just said, that's applicable to everybody out there. So that's where this advice or this education is applicable. Everybody can do Roth IRAs and backdoor Roth IRAs. You may not have a TSP, but you may have a 401k that gives you a match. So these lessons, go across spectrums here. I think some other, another one I had written down as kind of a base hit is doing feel-good Roth conversions. So that's where we say, we could convert $1 million of your TSP this year, but we don't think that's a good idea. But maybe we only do 10 or 20 or 30,000. We do what's called bracket topping, and that in and of itself, not going to change the trajectory of your financial plan that 1 year. But if we did 10 years of it, all of a sudden we've got 300,000 in Roth that'll never be taxed again. So it's these incremental steps can add up.
And when we started talking about this, John, years ago, we talked about it like we hit. And that's the way, as the financial advisor, we hit the base hit. It's because we gave the advice, to do something that wasn't earth-shattering, but it was a base hit, and if you do small ball enough, big ball wins. So I would say that, and we don't talk about this one near enough, we do have a podcast on it, but typically, if you're a non-smoker in average good health, buying option B, Federal Employees Group Life Insurance, that needs to be replaced with an individually underwritten term. Keep your basic. We like basic, but helping a client, get that insurance coverage they need at a much more affordable rate.
All this seems so small, right? If you're 50 years old and you replace FEGLI option B and it's costing you $50 a month and you get an individual term and it's $40, you're like, oh, I don't know. Is it really worth all that time and all that hassle to save $10 a month? Well, yes, it was, because not only did you save it for 10 or 15 or 20 years, you also had a conversion option on that term policy. You wake up terminally ill at 65 and you have a conversion versus continually escalating FEGLI option B premiums. And oh, by the way, you're retired, you have all these great pensions, and you're hitting Medicare IRMA or bumping into the next tax bracket or losing tax credits. Sure would have been nice to have some tax-free Roth IRAs that we had access to avoid tipping the scales out of favor. So again, we're not really going to know how lucrative or how beneficial this advice is until much later in the financial plan. These decisions just keep stacking on top of each other. Another one, which isn't applicable today, but it was applicable for most of our career, Tommy, Ben, and I, is we're refinancing when rates were low. Like, that was such an easy win. We think, not calling a market top or bottom, eventually all of you who bought a house, there probably will be a refinance opportunity for you in the future too. So whether you're looking at capcenter.com or wherever you look at your interest rates on your mortgages, be on the lookout if you've bought a house in the last 12 to 18 months. Refinance is an easy one. This open season, sorry, you're not going to hear this now, but it is October 30. You'll hear this after open enrollment, but like switching to Blue Cross Blue Shield Basic from Standard could be an awesome opportunity.
And I'm so glad you brought that up. I was thinking about a case that Mike and I worked not too long ago, and I guess it would be these base hits, but they added up to, it was like $10,000 or $11,000 a year in savings, which is always exciting when we're able to add that together. And it was, I remember it was a combination of FEGLI, changing our FEGLI election and changing FEHB. And again, I mean, it seems like these are base hits, but $10,000 a year in savings is material, particularly compound that over 30, 40 years.
No doubt. I mean, Blue Cross Blue Shield Standard to Basic, Tommy, is $200 a month. $200 a month savings or more, especially. And then if you were two federal employees enrolled in family coverage or self plus one, and you should have been single, that's even more.
I think this one may have even been, we had too much insurance, right? So we were able to give some advice here. And one of it was we had TRICARE for life. And that was where, okay, well, we really just need TRICARE plus Medicare B, and let's suspend FEHB. So we still, I don't know if that's a base hit or a home run that we can go back to FEHB down the road.
Let me tell you, sometimes these base hits are as hard as they can be for us. Like the couple we met in Seattle, that they both should have health insurance in their own right. Both work for the FBI, and he had self plus one. And they would have just said, heck with it, we'll stay this way if they weren't hiring a financial planner because they're so well off. But it's work. It's work to get the government. It's not something you do in open season. You actually have to, and nobody at HR, we've never had anybody ask this before. How are we going to do that? I think this is the form you use. And the 4 or 5 clients that we've helped do this before, it's a 5 or 6 month process. It takes that long, for somebody to get their own health insurance that deserves it, right?
Unbelievable. Well, now let's transition over to the next category, and that is a bunt. So bunts are, by nature in baseball, if you're not a baseball fan, you're basically giving yourself up, right? So the pitcher throws the ball. I do a sacrifice bunt most of the time to move or advance the runners to give my team the best chance of scoring. Essentially, I'm saying I want to get them in the scoring position. The game's changed. People don't really bunt anymore, but like it used to be a big thing. They now have some sort of analytics that tell them not to. But in our world, what is a bunt? And I wrote down delaying Social Security is a bunt. And the reason I think of that, and it's actually on both sides, the advisor is bunting and so is the client. And why is that? Well, if you're going to delay Social Security, you have to give up something. You have to give up guaranteed income in exchange for spending your own money. So that is a bunt. That is saying, like, I'm making a decision for the greater good of my financial plan to delay my Social Security. In exchange for that, I need to spend my own money, or I need to spend less money, right? But in either scenario, you're giving up something. Whoever wants to take the advisor end, how is the advisor bunting when we're encouraging clients to delay Social Security?
Well, obviously, if you're delaying Social Security, there is an income replacement that you need for those years that you don't have Social Security. Normally, that's made up through distributions from either your TSP or an IRA, maybe a Roth IRA. And I think we've been very honest about the way we get paid. We get paid for the assets that we manage. But if it works out for your financial plan and you're going to have more long-term success by delaying Social Security, then absolutely, we're going to say, take more money from your portfolio now to make up those income distributions and delay your Social Security. So it's certainly us giving up something, but as fiduciaries and acting in your best interest, absolutely delay Social Security if it makes sense for your plan.
Short-term pain for long-term gain.
Absolutely.
And that's on both sides, right? That's the client having to get over that mental hurdle of spending their own money. That's the advisor potentially getting compensated on less assets because of that decision. Short-term pain for long-term gain. And it's certainly better if I'm a consumer and I'm thinking I need to hire or I want to interview a financial planner. The worst question that they can ask, hello, Joe, you're a financialplanner.com. Are you a fiduciary? Like, that is the worst. You don't get anywhere with that question. Maybe you should call.
John, are you honest?
Yeah, you don't get anything from that, because everybody, even people who aren't bound or regulated by the fiduciary standard, are going to say yes because they're not fiduciaries and they're probably allowed to not tell the full truth, right? So everybody is going to say yes to that question. Maybe we should be asking, do you bunt? And then and then see what they say to that. Do you bunt? Are you willing to make all of those hard things? Are you willing to do all the work that nobody else has ever wanted to do? And then what is your process for success that's going to make sure that you continue to do all those things?
And we're going to talk about home runs and maybe grand slam home runs. But during this sacrifice bunt discussion, understand you never know the impact of what is, that bunt is going to do to the game. What's going to cause the game to be won? So don't think of it as small advice. It may not be as sexy advice, but if you and your spouse live to 95 years old, delaying Social Security to age 70, was effectively a grand slam. It looked like a bunt. When you did it, it becomes a grand slam in the plan.
I think we wrote another one down, didn't we, guys? We talked about maybe taking survivor benefits. We also talked about working until age 62.
Oh, yeah. I mean, you work, let's say you're going to end up with 40 years. You could have retired at 60 and 38 years, or you can work 2 more years, and you get the credit for working 4, right? Because you get 1.1 for every year of service. So.
And we've seen it too, where that decision isn't 2 years. It might be a couple of months. You might be a couple of months away from increasing your income by 10% for the rest of your life for as long as you are around. I mean, again, that's another one. It's small ball, but when you think about 2 months of my time, is it small ball? That might be a grand slam.
That to me might be like knowing to lace your shoes up. In that case, if we're like a couple months away, are we playing the game at all here?
Exactly.
Well, yeah, and to your point is, I think all of you are making this point indirectly, is that human resources or OPM or whoever, like by nature, these are good people. Like, let's not say anything disparaging, because we all believe that they're doing their best. But frankly, there are some like plays, like the flea flicker. Now we're going into football. Like, they just aren't called that often. And not many people are always familiar with the plays that aren't called that often. So, self, switching from self plus one to self. That play is not called very often. Suspending your health insurance on RI 79-9 is not called very often. Understanding the benefits administration letter as it relates to what is service eligible to get you credit for the 20 years and age 62 and that 1.1 multiplier. Like, these plays are not called that often. And human resources, they're doing their best. They absolutely are doing their best. But when you have 3, 4, 5 decades of experience serving federal employees, we know where to source this material, where maybe that new HR person, maybe they've only been there for a couple weeks, and we, Tommy, I know you and I, we don't want to go on too big of a tangent, but we had a client trying to suspend federal employee health benefits for like a year. And the HR person said, no, your financial planner doesn't know what he's talking about. And financial planners don't know everything. And then 7 months later came back and said, well, your financial planner was right. We need to use the RI 79-9. So it's like, that was pretty frustrating.
They definitely ran us over with the bus. Like, called us out individually that we didn't know what we were talking about. So, but it was pretty gratifying for us to say, fine, listen to them if you want. And then 7 months later, hey, you guys were right. And we're fixing all of this now. And because we could actually document that you guys were right, they're going to pay us what the back premiums that we shouldn't have paid to begin with.
So couple other categories, right? Maybe we just go straight to steals. I think we can do that one pretty quickly. And then we'll hit home runs, grand slams, wrap up the episode.
Sure.
So steals, I don't know if you guys all agree with me or not, but steals feels like tax advice to me. It feels like, and we're not tax evasion. We're not like, truly, there's not a lot of ways to reduce one's tax bill, right? People always come into our office and they say, I'm paying so many taxes, I need you to reduce it. And it's like, well, that's really not possible unless you have a lot of kids or you give a lot of your money away to charity. There's not a lot that we can do to actually reduce your taxes, right?
And by the way, they weren't paying a whole lot anyhow.
Right.
Right.
Outside of like the normal TSP 401k. So why, to me, is tax advice or tax planning or tax action stealing? It's like taking advantage of something or using the rules to our advantage where nobody else is doing it, right? People are not critically thinking about, if I do this Roth conversion this year, then it's going to help me not go over my IRMA. Or if I do this year, it's going to lower my total lifetime federal tax paid. To me, it just feels like the deck has kind of been like stacked against us. And every time we make a tax wise move, we've like stolen some of it back, right? Like we're taking back what's ours a little bit. So that's why I think it's a stolen base.
Yeah, I mean, QCD, given to your church from your IRA instead of from your bank account.
That's amazing. That's because you didn't pay tax and then the church didn't pay tax. That's perfect.
Went in tax-free, came out tax-free, didn't hit anything. It's beautiful.
That's definitely a stolen base.
I mean, John, you talked about it before. It's the backdoor Roth, right? You make too much income, you should not be able to contribute to Roth IRAs. But if we do it this particular way, we can still get money into those accounts. We feel like we're breaking the rules, but we are playing well within the guidelines, and we can continue to build up those Roth accounts.
So taxes are one of the largest bills that most of our clients, if not all of our clients, will pay in retirement. And maybe just a quick call out to your tax plan is really, how do we reduce total federal tax paid over 30, 40, 50 years? And in order to execute that tax plan, guys, we have to do annual tactical adjustments, right? So you have this like overarching like long-term tax plan, but that requires annual meetings with somebody who's willing to give tax advice to actually steal back what's yours, frankly.
I'll give you.
And when we say this, and we've said it multiple times, working with somebody who's willing to give tax advice, understand the majority of the people in my business, which some people think everybody that's a financial planner is in the financial planning business. Not necessarily so. But if your financial advisor is not giving you tax advice, it's because he doesn't know his rules or he doesn't know the tax rules. But it's not because they're not able to, because just in the easiest sense, if they help you open a Roth IRA, they have given tax advice. So if they're smart enough to know you should have a Roth IRA, then they should be smart enough to know you should do QCD, and they should know how to do it, right? And they should know how to do Roth conversions and backdoor Roth conversions.
A couple steals. I know we probably need to move pretty quickly here, but one that came to mind was utilizing the 0% capital gains rate. To me, that feels like, typically I should pay tax when I realize capital gains. And if we do this right and our situation is right, being able to do it at no federal income tax, that seems like a steal in my book. The other one is when we have a brokerage account, kicking off dividends, gains, and so forth, and we don't take these other steps we just talked about, where it's, hey, we could fund a Roth IRA or an IRA. We could move this into a tax preference vehicle. And usually people think, well, I don't have the cash in the bank. but we have this taxable asset, this taxable brokerage account. Let's just move it from one pocket to the other. That feels like a steal.
I love that capital gains one. That one's just beautiful. Yeah. It's like everybody told you were always going to have to pay tax on that long-term capital gain until you didn't have to. You know, it's amazing. Yeah. And then harvesting losses to offset future gains is another opportunity. So let's transition now into a few of the big hitters. So the Hank Aaron, the Barry Bonds, Sammy Sosa, Mark McGwire, in today's game, Shohei Ohtani, right? Acuna Jr. So let's talk about some extra base hits, some big grand slam home run opportunities.
You know, the first one that comes to mind is maybe you didn't do a 20-year career in the military, but you did 4 years at the academy, or maybe you did do a 20 or 30 years. You can't buy the 20 or 30 years, you know, towards your federal, but you can buy the 4 years of academy time. So that's a home run, buying academy time. Buying military time that didn't result in a retirement. I did almost 6 years in the Air Force. You know, if I had a federal employment opportunity, I would buy those 6 years. That's a fastball grooved right down the middle home run is what that is.
The one that always is the easiest when we start thinking about home runs, particularly with our federal, is that CSRS offset, the voluntary contribution plan, the VCP. The biggest mega backdoor. We can take funds that have already been taxed hundreds of thousands, move them through the VCP and into a Roth IRA where it's never taxed again. And it almost feels, it's like a grand slam steal because you didn't pay any tax to do that. So that's got to be a grand slam.
That's a big one. Yep.
I think when you think about home runs and extra base hits and grand slams, I mean, ultimately those can win you the game. And to me, I think it's just coming to the realization that if I do all of the little things right over time, I get to the same result. Doing all of the little things right at the end of the day equals a home run in my financial plan. Taking all of the right steps, doing all of the right things, not looking for instant success or instant gratification, that's your home run or your grand slam. Federal employees should know by now, you know, through our podcasts and our clients and our YouTube channel, things are what they seem, support, empower, educate, motivate. You're different. You live in a different world than everybody else. And I think it's just so important to understand that, like, you have a really good financial plan. You make all the right decisions over time. We don't need to hit lotto ticket. We don't need to be swinging for the fence, I guess is what I'm saying. Like, so many people buy lotto tickets. So many people take unnecessary risks. So many people are holding single stocks, and they're doing all of this stuff because they think they're losing the game, but they're not. So sometimes we should just not swing for the fences because we don't need to. Maybe that's your home run.
Solid advice. I guess are we getting into the wrap up here?
Yeah, let's wrap up with some action items.
I think my action item is, well, one, I think putting in the work, doing the base hits puts you in the position to hit the grand slams a lot of the time. So kind of like that VCP example, you wouldn't have been able to fund it, to take advantage of it, if you hadn't accumulated funds to run through that. So I think base hits can put you to a position to make home runs. And my other action item here was really a call out, a request to our audience. If you can, we love to hear from you. Please send us some questions, send us some topics you'd like to hear about. And we don't have to answer them in a podcast format. We'd be more than happy to shoot a quick video and post it on YouTube. So we'd love to hear from you. Please reach out.
Just like there are good and bad managers in the game of baseball, really bad managers can actually lose you some games, and really good managers can win you some games. You need to work with a good financial advisor. And what I mean by good is working with someone that knows your benefits. A lot of these base hits are things that apply to both federal and non-federal people, but some of them are very specific to federal employees only. If you're working with an advisor that doesn't know these things, you're never going to get the base hit. And then there's even some of those grand slams that we talked about that you exclusively have available that nobody else does. Imagine having a grand slam in your back pocket, but you can't use it because your manager never told you about it.
Yeah, and as my closing comments, as I think about this, maybe the grand slam in our mind is a grand slam because it was so instantaneous. You could see at that very moment how you've changed somebody's life. we call them Clarence moments and hero stories at Mason and Associates. So maybe it's just so apparent because, again, those things we call bunts could be just as impactful. But, when you help somebody buy survivor benefits when they didn't think they could get it because they've been retired 6 months, and you help them buy it on Friday, and they're dead on Tuesday, and their spouse since 2000 is $55,000 cost of living adjusted, that's a grand slam instantly when you did it. The reason it happened so fast is we knew he was terminal, and we were able to make it happen. That was a grand slam. It's impactful. So those grand slams, Clarence moments, hero stories.
I think we have to know the score is what it comes down to, right? And over time, you can win a game a lot of different ways. You can win the game with a grand slam that happens instantly where you can see the result, or sometimes it takes a full 9 innings, and a lot of walks and a lot of hit by pitches and a lot of stolen bases and a lot of base hits and some good managers and some good coaches and the right people on the field. And at the end of 9 innings, because your game of life is 9 innings, it's a long ball game. And if you're listening to this podcast and you're 50 to 60 years old, it's like the 4th or 5th inning. We've got a lot of baseball left. And we certainly would love to throw our hat in the ring and say, if you're not working with a financial planner, give us a call, shoot us an email, masonfp@masonllc.net, masonfp, like financial planning, at masonllc.net. Our website, again, masonllc.net, YouTube channel. Folks, Tommy said it earlier, do all the things for us, like, subscribe, hit those bell notifications, leave us some comments and reviews. We'd love to hear from you. This is another episode of the Mason & Associates Federal Employee Financial Planning Podcast. It is our pleasure, it's our honor to be here with you for almost 2 years. Remember, we're financial planners first, we do this second. And our mission, support, empower, educate, and motivate you to make changes in your financial plan. We'll see you next time.
You will rest easy once your plan's done. You will see clearly just how you have won.
The topics discussed on this podcast represent our best understanding of federal benefits and are for informational and educational purposes only and should not be construed as investment, financial planning, or other professional advice. We encourage you to consult with the Office of Personnel Management and one or more professional advisors before taking any action based on the information presented.